Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 152nd VideoCast, 142nd podcast for the week ending September 15th, 2022. Been an interesting week to say the least. We're going to get into the inflation numbers. As many of you know, our website is down. Hedgefundtips.com. Bluehost is the host. They've got thousands of websites down the last 2 days. They say they're working on it. I like this quote from many of the thousands of people on Twitter complaining that their sites are down. He said, "While I'm annoyed my website is down because of Bluehost, I find the complaints on Twitter to be a nice confirmation that misery loves company." So, nonetheless, the good news is that there are alternative ways to get out our message. We have the email list. We've posted our article of the week on LinkedIn, which I think is going to be a good thing moving forward. Will be part of our syndication. And we'll kick it off with the media and get right down to the information. So thanks for tuning in. First off, want to thank Will Colaris, Gabrielle C., and Celestine Francis, as well as Ginny Go, for having me on CNBC Street Signs Asia on Tuesday night to discuss stock market inflation, home builders, China, bonds, etc. We're going to go into some detail. I was on right after Mr. Wonderful, billionaire investor Kevin Leary, and he had some interesting things to say about China, which we'll get into as well. I want to thank Bansari Kamdar for including me in her article after the inflation print, the CPI one on Tuesday, which came in higher than expected, but not quite as bad as everyone thinks. We'll talk about that today. I said the good news is the peak narrative holds as July was the highest print. The bad news is July, meaning it was printed in July, but it was the June month. The bad news is the upside miss cements a third 75 basis points hike next week. So the market will trade heavy for a day or two until participants can refocus on fundamentals and earnings of businesses, which are holding up nicely despite a challenging environment. I think that's a good way to start off today. And then with Peter Lynch, the most important organ in the body, as far as the stock market is concerned, is the guts, not the head. Anyone can acquire the know-how for analyzing stocks. We agree. Let's get out to some overview because there's a lot of confusion in the market. But what are the extreme indicators showing us? This 10-day put-call ratio is extended. This is generally, with the exception of the pandemic, where you want to be a buyer, not a seller. I don't see any pandemic coming around the corner, and I certainly don't see a great financial crisis coming around the corner because debt levels are much lower than they were during previous crises. NASDAQ 1% EMA, advanced decline ratio, that started to come off the bottom. Then we got hit over the head a little bit this week with the CPI print, but I think that'll work itself out. Now everyone is in a trading range until Powell speaks. We know he's going 75 now. The question is, what will his guidance be moving forward? And I think he has to be very, very careful because there are already two 75-point hikes in the hopper that have happened. And not waiting for the lagged effect, he could definitely drive the economy into a strong recession if he goes too heavy with the cuts, with the hikes, and with the guidance. But I think we'll see if it's going to be 75-50-50 or 75-50-25. And we'll get a little color on that. But owner's equivalent rent, we're going to talk about. That kind of misled the CPI print because they changed how that's measured. And with housing prices coming down, owner's equivalent rent comes down on a lag basis as well. But that's kind of misrepresented in how they're calculating it right now. But as we see, more and more of these indicators are near areas of buying versus where you want to be buying versus where you want to be selling. Even the real estate, this is correlated with rates. Rates are up, yields are up on the basis of the print, but these tend to bottom out and go up as rates get compressed. And we talked about it on CNBC. We're going to cover that in this podcast, VideoCast. Dow, intermediate term breadth momentum, same thing, where you want to be a buyer or seller, same thing with mid caps. NASDAQ volume momentum. So all these things, equity, National Association of Active Investment Managers down at 33%. Only was this low at the pandemic lows. So you tell me, is something worse than the pandemic coming in the next 2 months? I'll take the other side of that trade. PMO by all, like we said last week, it had touched 1, but sometimes they stay that way for a couple weeks before reversing. And I think that's what we're just dealing with right now, the seasonality of September. I think there's the old saying, sell Rosh Hashanah, buy Yom Kippur, or some ridiculous thing. But it tends to be a seasonally weak period in the short term, and then a rally into the end of the year. Everyone's kind of looking for that, which is why I think we're not going to go retest those June lows. But if we do, 2 weeks of just waiting is not the end of the world. PMO by SPX, same thing. These things can stay down for a little while, but these are areas where you want to buy, not sell. Pring diffusion. That's interesting. Pring emerging market diffusion indicator. This is, we have the SPX on the bottom, but actually, if you put the emerging markets on the bottom, this is a pretty good indicator for emerging markets where you want to be a buyer versus a seller as well, which, as we've said repeatedly, is going to depend on when the dollar starts to turn. But when it gets this low, it can be an interesting place to go. So you get the point on the overview of the market. Here was another one that we put out on Monday or Sunday. This was the NASDAQ percentage of stocks above the 200-day moving average. I mean, this goes all the way back to the great financial crisis. The last time they were this low was the European debt crisis. You wanted to be a buyer that October. We're lower than we were then. And then you had the 2016 thing with the high yield market. That reversed quickly. The 2018 thing when Powell almost threw the economy off the cliff and had to reverse on Christmas Eve, and then the pandemic. So every single one of those times was huge buy opportunities in equity markets. We're back to the future. We're there once again. Billionaire investor Mr. Wonderful said the stock market route is a buying opportunity, especially in China. And it's funny, I was in the queue with the producers waiting to go on, and I'm listening to Kevin O'Leary basically steal my whole spiel ahead of me. So billionaire investor Kevin Leary, nicknamed Mr. Wonderful, he's on Shark Tank, is advising people to invest more in Chinese stocks. What he says is, if you're looking for long-term secular growth, there's no question the Chinese economy over the next 20 to 25 years is going to become the largest on earth. There's no stopping that. There's no denying it. I disagree with him on that. I think over the next 3 to 5 years, it's going to be the biggest outperformer. But as we covered 3 weeks ago, I think it becomes Japan after, call it, what are we in, 2022? So after 2027, by the end of this decade, it will peak just like Japan did at the end of the 80s because of their aging population. But with all moves, the last part of the move is the parabolic move to the upside. And I think they're going to see the most growth in the shortest period of time over the next 5 years before finally peaking. And O'Leary, who invests in Chinese stocks, says the growth of China's internet behemoths reflects a consumer emergence, much like the earlier consumer emergence in the U.S. economy, and could offer similar profits for investors. If you own Amazon, why don't you own Alibaba? O'Leary asked, referring to multinational e-commerce giant Alibaba. And let's see. Here it is. Yeah, yep. The founder of investment company O'Leary Ventures and a shark on ABC Shark Tank said on CNBC's Street Signs Asia on Wednesday. It was Tuesday night, Wednesday morning for Street Signs Asia. So they're quoting him from right before he went on, right before I went on CNBC Street Signs Asia. So we agree with Mr. Wonderful on this case, and I guess several others. And here was the promotion that CNBC put out. Moving right along, Sumit Kapoor, you may recognize his name because he's asked so many AMA questions over the last 2 or 3 years on our podcast. He's been an ardent follower and supporter, and he seems to have internalized some of the lessons because he put out a great thread on Twitter this week. These 10 catalysts are lined up for Alibaba to significantly appreciate before year end, and he tagged me on it. So great work, Sumit. He said, one conclusion. So basically he compiled all the things that we've been talking about, and he did go into further detail on one of them, which I thought was really interesting, was the conclusion of SoftBank's Alibaba stock sale by September end. In August, SoftBank announced they will sell a maximum of 242 million Baba ADRs to FIs. As part of this deal, the closer Baba's price was to 91.19, the higher the number of ADRs the FLs would receive. So this was the press release. 91.19 was the closing price of Baba on August 9th when the deal was signed. Guess what? The average price of Baba has been between August 10th and September 9th, has been 92.79, within 2% of 91.19. During the time frame, the minimum and max volume per day of the ADRs, you can see is big time volume. Traded were 11 million and 46 million, or between 4% and 19% of the potential 242 million ADRs that they may receive in this deal. Therefore, financial institutions may receive as part of this deal. Therefore, the financial institutions had access to enough Baba ADRs to short them. If Baba price were to move substantially above 91.19, the financial institutions would not have had to short enough Baba ADRs, especially given the prevailing negative sentiment for Chinese equities. After September, when this deal consummates, incentives of financial institutions will flip, and they will want Baba shares to appreciate to maximize their profits. Goldman and UBS, who were part of this deal, will report Baba in their Forms 13D and F, which may inspire other investors to become interested in Baba. I disagree with that. On a side note, this is an excellent deal for financial institutions. What about SoftBank Group? May end up losing up to 38% of shares in their best investment yet. What are the consequences? Rajiv Misra, ex-UBS and rumored to be Masa-san's successor, recently stepped down as a corporate officer. Okay, so then he goes into the remaining catalysts, which are the PCAOB auditors land in Hong Kong next week. That's this week, to audit Alibaba. And I was kind of laughing at the website being down, because what I found in life is, before the biggest quantum leaps and the biggest breakthroughs, you always have breakdowns before the breakthrough. I mean, literally, my website's down for 2 days. When does this kind of craziness happen? It's just bananas. So my guess is we're on to something big here. Maybe this will be the catalyst. And we know from the annual report that PwC has said that we've conducted Baba's audits in accordance with the standards of the PCAOB since 1999. So I think it's going to be a non-issue there for the listing. It'll take some overhang off the stock, etc. So he goes into some great detail on this. Additional stimulus from Chinese stimulus measures. We've covered all that. COVID cases rolling over. We've covered that. The upgrade we covered on last week's call, he put in there. The podcast he put in there for number 7. GavCal is talking about they'll drop the tariffs at the G20 when Putin and not Putin, Xi and Biden meet. We'll see. Won't hold our breath there. Xi could provide boost to China's stock market. This is ahead of the China National Congress. We'll see. I mean, time is running short on that thesis. And then change in consumer sentiment will cause them to re-rate. I mean, that's opinion follows trend as we get one of these catalysts to kick in. The ones that I covered on CNBC, though, were, just kind of some of the parts, with current assets at 102 billion, cash over 73, the market cap at whatever it is, 270 billion. They could basically buy in, a third to a half of the shares, number one. Number two, people continue to forget they still own a third of Ant Financial, which was going to IPO at 300 billion. So call it's worth 200 billion. That's another 70 billion. So now you're at 170 billion. And then you've got the cloud that's going to triple over between now and 2025. Alibaba's got 36, close to 37% share. That could drop 20 to 30 billion to the bottom line. You give that a 10 multiple, that's another 200 billion. So you got basically a $400 or $500 billion stock before you even get into the e-commerce business, the growth that's going to come from the stimulus, the lag stimulus as COVID's dying down. And what I like to say is, I responded to someone on Twitter when they were saying, "Oh, more shutdowns, blah blah blah." I said, "Listen, COVID zero is temporary. Business modes are permanent." And in the case of Alibaba, they're first mover on all of these key factors. No one's going to unseat Amazon in the United States. No one's going to unseat Alibaba in China and Asia. And it's just a question of getting through these short-term headwinds and the smoke, and we'll go from there. So great thread from Sumit, one of our loyal listeners and great learners. He also put, I don't really generally care about analyst ratings, but in the case of Morningstar, they are pretty good because these guys, they were always out at the Buffett annual meetings with us. They're steeped in, Buffettology, so to speak, and analysis and valuation. So they do good work. If you read any of their reports on stocks, it's not like the normal sell side nonsense because they don't have conflicts. And Sumit pointed out that according to Morningstar, Baba is selling at 50% discount to its fair value, the highest discount of KWEB, which is the China Internet ETF top 10 holdings. We agree with that, and they'll take this rate, just like the sell side, they'll take this rating up even higher once the stock moves up. That's the PCAOB, that's the COVID cases. And then finally, CalSTRS, which is the California State Teachers Retirement System. This is from Marcel Munch. You may remember I was on his podcast a number of months ago, and he's got a lot of great followers that are super, not only Alibaba fans, but NIO. They're big into NIO, one of the electric car companies over in China, and always love them. They do a great job. But anyway, they're looking to appoint China-focused equity managers for the first time ever. They've got $312 billion under management. So my guess is they're getting ready to front run what's happening at the end of the year with the dual listing, with $30 billion of demand for what we expect to be Alibaba demand before the end of the year from mainland China through the Stock Connect once they have the dual primary listing. And I think enough institutions are going to be smart enough to front run the mainland Chinese retail investors that are coming in. They own about $30 billion worth of Tencent. That's where we get that figure from. They've wanted to own Baba for decades, and now they're finally getting the chance. And that'll happen with the Stock Connect listing. So Chinese rush to repay mortgage gains, momentum in abrupt U-turn. You may have caught the note that I put out that Evergrande restarted like 90% of their projects that were stalled. And the movement to quickly pay off mortgages is an abrupt U-turn for many Chinese people who used to go all out to borrow funds to buy houses during the real estate boom years. As the property market slumps, the once sought after leverage has turned into a burden that some say they must trim or get rid of. So that'll be good for the banking sector as those get paid down, and for the credit system, which is good. Chinese Chengdu exits full citywide COVID lockdown on Thursday. So that's today. They finally ended that new lockdown. Chinese bank, this is important. Chinese banks cut deposit rates in first broad move since 2015. If you followed Chinese markets, that was a good year to be a buyer. 7 major banks reduced benchmark deposit rates for clients. Move comes amid efforts by Beijing to boost economic growth. So basically, we're not going to pay you anything. You got to put it to work. In other words, if you keep it in the bank account, you will lose money consistently to inflation. It's almost like putting a time fuse on a transfer payment. If you say, we're going to help you out with food and stuff like that, but you got to spend it within 30 days. Well, people are not going to wait 31 days. It's the same when you have inflation and you lower the interest rate on deposits. People are going to figure out how to invest it or save or spend it versus let it sit in the bank in fear, because obviously people were hoarding their money, not knowing when the next shutdown was going to be. And now the government's saying, well, you don't know when the next shutdown is going to be, but if you hoard, you're going to lose. And so they're trying to force their people to spend and to invest. Tencent secures first China video game license in 15 months. So that's positive. That was one big overhang on some of the China internet stocks. Evergrande has resumed construction on 668 of 706 China projects. Now on to the general market. This is from a guy named Milton Berg. S&P 500 generated an 80-to-1 downside to upside declines to advances ratio. I guess that was on Tuesday with the knee jerk to the CPI. This occurred 27 times since 1980. 120 days later, the S&P 500 had gained in price 80% of the time for a median gain of 13.23%. And the median decline, the other 20% of instances, was 4.26%. Now, this is very important. We cut the video from CNBC. We saw it live. We have YouTube TV. We cut the video of one of our favorite sell-side strategists, Jim Paulson of Luthold. And what he said, and he also said in his notes, Seth Golden put out, during each of the previous 7 major inflation cycles, after the annual inflation rate peaked, which it did in June, by the way, the stock market essentially bottomed out, Paulson wrote today. Consequently, based on the big inflation cycles of the last 100 years, this current stock market low is already in because the inflation rate has already peaked. We've been saying this since June. Jim Paulson put this out. It's very, very exciting to see that. He goes through every single cycle where the year-on-year was above 6%. And what's perfect about this is when inflation peaked this cycle, guess what? Was June, and the bottom of the market was also in June. So that's very positive to see. World Container Index, this is Seth Golden over on Twitter, also collapsing. So look, Tuesday's report was one report. We saw on Wednesday the PPI is doing a lot better. PPI, Producer Price Index, is a leading indicator. CPI is a lagging indicator. This is a cutout of one of Jim Paulson's in each of the 7 inflation cycles. The bottom of the stock market was already in, and he shows these 3 right here. And I think that 2022 is going to be no different. This is Larry Williams. He's a technician. This is this timing solution software where you can put all these crazy things in, variables and planets and yada, yada, yada. It's a timing. I have the software. We used it a bunch for a while. I mean, it's okay. But he's been pretty good this year, Larry Williams. So he runs in streaks, and this year he's been on a pretty good hot streak. His basic thesis is that you get one more dip and then put your rally hat on, folks. And the market's going to rip higher into 2023. Whether we get this other dip or not, I'd say no, but it really doesn't matter if we got to wait a few more weeks before we get the end of the year rally. And that's what he's been saying, and he's been hot this year, so it's worth a look. Okay, Bank of America Fund Manager Survey shows risk appetite and risk-taking at levels not seen since the 2008 Great Financial Crisis. Lows, every time risk appetite was at extremes, markets surged. Here we are again. This is just one more thing. 2008 it happened, 2011 it happened, 2016 it happened, and it's going to happen this time as well in our view. Now, this is a really important point from Seth Golden. People are saying that now people are borrowing to stay afloat. When you look at the data, it's just the opposite. Household balance sheet is in the best shape since the 1970s. And if you look here, you can see that household debt service payments as a percent of disposable personal income are at 4 or 5 decade lows. So don't buy the hype. Producer prices decelerate faster than expected. That won't change the Fed's plans. Probably not. 75 basis points was already kind of expected before the 1,200 point drop on Tuesday. So they'll probably keep with that. The key is going to be the guidance going forward, and the fact that we have the sterilization of the quantitative tightening, which I think is also going to be positive. We covered that last week. We'll get into that here, which was basically that while the Fed is doing $95 billion a month of quantitative tightening, we have something that we did not have during the last tightening cycle, which is $2.2 trillion in the reverse repo. And what Kevin Muir says in this Bloomberg article is, the abundance of liquidity is evident from the reverse repo operations growth to its present 2.18 trillion size from virtually nothing before the pandemic. Institutions have more cash than they know what to do with, so they're parking their money at the Fed. And that's a good thing. So that will sterilize any fears about quantitative tightening. What they should do based on that, and they've got $800 billion in the Treasury General Account, which operates like the government's checking account at the central bank, is they should talk up quantitative tightening to bring down inflation expectations and not go so crazy on the hiking, because the quantitative tightening is sterilized and the hiking is not. So that would kind of be my strategy in their shoes. We'll see if they follow that. That would make too much sense, but stay tuned. Jess Menton put out a really cool article on Bloomberg about the CPI minus PPI spread remains negative but is narrowing. Positive spreads historically point to higher equity returns. So you can see here it's coming up to, it's just about turning positive. That spread, and that bodes good things to come in the equity markets. And it really speaks to what I'm saying, is that the CPI is a lagging indicator versus the PPI, which is the leading, and the PPI came in pretty good this week. Barry Sternlicht, big real estate guy out of Miami, used to be New York. Starwood Properties was on CNBC this morning saying Fed needs to pump the brakes on rate hikes. If it doesn't, it will cause a serious recession. We kind of agree with him on that. I don't know if he needs to pump the brake on them, but they, I think if they did 25 next week, which is not going to happen, but if they did 25 or 0 next week and waited 90 days, I think the inflation numbers would still be a lot lower. And we're going to look at some of the inflation numbers because you get headlines and then you get facts. They're already rolling over. So I agree with him. This stuff works on a 6 to 9 month lag basis. And we only started cutting in March, and we've just done 2 75 basis point hikes. But everyone likes the emotional panic on every backward looking print. So they always overshoot, which is not a good thing. But all that means is they're going to have to reverse quicker, which is a good thing. And my guess is we'll be seeing cuts by within the first half of 2023. Elon Musk says Fed should drop 25 basis points instead of raising, saying that a major hike would risk deflation. We agree. He is kind of in this camp that the developed world population is getting too old, and we face serious risks on that behalf. I agree. Moving along, Southwest Airlines sees strong demand trends. Business travel may be coming back. I was planning to cover Expedia on this basis on CNBC. We didn't have time, but just like we saw the leisure travel, revenge travel happening over the summer and in the last 6 months, we are seeing the same thing with business travel coming back for the first time in major ways. As a matter of fact, 5 of the last 15 days, it may be 6 or 7 now, I haven't looked since Tuesday, but have higher TSA pass-through numbers than the equivalent day in 2019 pre-pandemic. So that business travel is coming back in earnest. Here was an article from Barron's. Buy Nordstrom analyst says young and rich will keep spending. I think that's a very interesting play to keep in mind. And now on to the article of the week, which I posted to LinkedIn because I don't have a website. Thank you, Bluehost. Okay, everything's going to be all right. Stock market and sentiment results. So whether Larry Williams is right with his timing solution software and astrology or whatever he's running through his timing cycles, or we're in the camp we don't get a retest of the June lows, it doesn't really matter because we'll get through it. And the market's going to start to discount gridlock. Okay, the Democrats are going to lose the House. They're probably going to keep the Senate. And what that means is that no new major policies will go through, no new taxes will go through, so the corporate tax rate stays low. That's a really good thing. And probably no major spending goes through. So that's also a good thing for inflation expectations. And I think the closer we get and the more those odds become apparent, the more the market is going to like it. Market loves gridlock, whether you have a Republican president and Democratic Senate and House, or you have a Democratic president and Democratic Senate and Republican House. It doesn't matter. You can't have all three in one party. It's just not good, as we saw, basically in the last 24 months. You don't want carte blanche for all Republicans, and you don't want carte blanche for all Democrats. Okay, so we talked about Kenny Chesney's song, Everything's Gonna Be All Right. Great song. Going to see John Party tonight in concert, so very excited about that here in Connecticut. Big country music fan. But the lyrics are, after what I said was, after this week's inflation numbers and knee-jerk reaction, investors need to keep in mind everything's going to be all right and nobody's got to worry about nothing. Don't go hitting that panic button like they did on Tuesday. Worth a listen if you like country. I echoed this sentiment on Tuesday evening after the 4% correction on CNBC Street Signs Asia with Will Kalaris. Everyone was panicking. We're kind of like, let's just step back and put this in perspective. We haven't even given up last week's gains yet. So thanks to Will, Gabrielle C., and Celestine Francis for having me on. The good news, we covered the peak narrative will hold as June was the highest print. The bad news is the 75 is pretty much a foregone conclusion now. The other thing to keep in mind is used car prices were down, but new car prices were up. Well, what we're seeing is that will work on a lag basis. The chips are coming in. The new cars will glut the market, and they'll start to come down. So that'll help CPI. Same thing with housing prices were down, but rents weren't down yet. But that works on a lag basis as demand comes down. So I said the market will trade heavy for a day or two until participants refocus on fundamentals. 5-year inflation break-evens went down to 262 from 359. Fed is focused on break-evens, which we've covered. And then I'm going to cover some of the Bank of America Fund Manager Survey. Unfortunately, I can't get to all of it because the site is down, but the key points I had ready to cover on CNBC. So I had my notes in the email from that. We have the highest expectations for recession since April of 2020 and March of 2009. Same as last month, by the way. But this report came out on Tuesday morning. If you'll note, the bottom was 1 month before that in March of 2020, and the bottom was March of 2009. So here in September of 2022, we think the bottom was June. Recession expectations are the highest since the pandemic lows and the great financial crisis lows, and we have nothing in line that's even similar to those situations, which is just amazing to see the level of kind of panic, which creates opportunities. Lowest percent of managers taking higher than normal risk in history. Lowest percentage of managers overweight equities in history, lower than 2020 pandemic lows and great financial 2008. People ask me, like, how did you make that such a great call on March 20th of 2020 when everyone was panicking in the middle of the pandemic? And it's indicators like this, understanding sentiment, looking at historic analogs, knowing when things are at extreme, that things are about to break and people need to step in. And we're at a similar situation now, and everyone wants to take the other side of the trade, which is good. You saw last week we covered the amount of puts that people were buying into this. Those things are not going to pay. And you'll see by expiration in October, everyone's expecting this huge 20% more. It's amazing the amount of people that come out of the woodwork after the market's down 10 and 20%, calling for 10 and 20% corrections. It's just mind-boggling. And usually it's the same people that were saying cash is trash when the market was at all-time highs, which is just, almost, it's hard to believe. But, okay, growth expectations near all-time lows. 72% expect weaker economy next year. Well, here is, which, by the way, they may be surprised because we had negative GDP growth in Q1 and Q2. I'm not sure that we're going to have negative GDP growth in Q1 and Q2 of 2023. I would take the other side of that trade because you're going to get the stimulus from China kicking in. I mean, China's basically been like an albatross around the world for the last 12 months because of silly policy. Wait till they get humming again, what's going to happen on a global basis. People are underestimating that. People other than Marko Kolanovic over at JP Morgan has been talking about that. But, these are the points in time when growth expectations were so low, you wanted to be a buyer. Even in 2006, you had another 2-year run. You could have made a ton of money. The bottom in December 2000 after the big tech wreck, the pandemic lows. We're lower than all of these points in terms of sentiment. The cash levels are higher than the great financial crisis, higher than the pandemic lows. All the way back to 2001, they haven't been higher. People are in panic mode. And that's when you want to be buying, when there's blood on the street. So, relative to the past 10 years, investors are long cash, defensives, and energy while being underweight equities, Eurozone, emerging markets, and cyclicals. I'll tell you what, as much as I love the emerging markets and all you have to do is watch the dollar for that trade, the Eurozone is getting attractive. And people are like, Eurozone? Well, they're going to freeze this winter. It's going to be a depression. That may be true, but everyone knows that. So then in the face of that, what do you buy that's high quality that when this is all resolved? I mean, you got this crazy news this week that Ukraine could even win the war, which would be unbelievable. I still think not the highest probability, but no one would have thought that 2 months ago. And what a surprise that would be. Imagine if you're in the highest cash position you've ever been in your life. And, all these body bags are going home to Russia. All these moms are losing faith in Putin. And all this, and NATO's pumping Ukraine full of weapons. Imagine you had an upside resolution like that. What would happen to energy, number one, and then equities and everything else? And you're in your highest amount of cash. You have the lowest amount of risk on in history. And then all of a sudden in one day, the market's up 6, 7, 8%. And then you get a gridlock in Congress. Then the market's up another 3, 4, 5%. You're still stuck in cash like you were in June and you missed the whole summer rally. What do you think happens into year end? And that's how these big moves happen. So take the other side. Looking a few months out, the pain trade is up. Market will start to discount gridlock after November elections. No new taxes or policy change equals bullish. Contrarian trades. Watch the smart money, not the emotional knee jerk. If you can step in at extremes when volatility and fear are high and be patient in the short term, you'll make outsized returns over time. So short the USD, commercial US dollar, commercial hedgers, green line at the bottom, aggressively short as was the case before peaks in 2020, 2017, 2015. Look, guys, I'm just pointing it out to you. 2013, 2009, 2006. So you can bet against them, but it would be the first time in 2 decades that they weren't right. That's all I have to say. And this is from Kimball Charting, just the other technical stuff he looks at. It's worth looking at, but not something worth making a decision off of. Long treasuries, 10-year note. Everyone right now thinks rates are going what? Up. Okay? Everyone is on that side of the boat. Well, let's take a look at other times that people were so darn certain that was going to be the case. Here's what commercials were doing. They were hedging and taking the other side of the trade. And guess what? You had a monster rally in bonds, a compression in yields. That was after the 2018 mishap of Powell. We could have the same exact thing. If you think he's not making mistakes tightening this much, just wait a few months. You're going to see what happens, and you're going to see how quickly he pivots. And it will probably come from the high yield market, by the way. 2017, same thing. You got this rally when everyone was short bonds. Same thing here in 2014. Bonds rallied, yields compress. Then 2011, same thing here. Bonds rallied. Same thing in 2009. Bonds rallied. So it just goes on and on and on and on. Same thing here. So the same thing with S&P futures. Commercial hedgers, green line at the bottom, aggressively long, as was the case before equity rallies in 2020. Here you go, right here. Boom, big rally. 2016. Commercials long, the green line. Boom, multi-year rally. 2011. Debt financial crisis. They're just as long as they are now. Boom, big rally. 2009. They were short, and now they're long, and boom, big rally. So, and then they wanted me to cover a few stocks. I just went into Alibaba, which we've already covered, the audit clearance, the Stock Connect, the buyer demand from mainland China, the massive stimulus, Ant Financial. Oh, and by the way, you get a great e-commerce business on top of it. Expedia, I was talking about the business travel, trading at 11.5 times next year, 38%, 34% earnings growth. and Lennar wait for bonds to get bid, trading at 5 times forward, starter home demand, etc. All the trades that no one wants right now. And it was funny, I kept talking with Will. I know it looks the opposite today. Just wait a couple of days. And he was laughing. So more on inflation, guys. Has inflation peaked? Just follow the trend. So you saw energy commodities down double digits. You saw energy services like utilities lagged. Those were the big contributors to the miss. And then used cars were down. And then we just went through a bunch of the consumer and producer metrics. What you can see in all cases is the trend has rolled over. So you can read through these to get granular, but we're not going to spend time on that here because you can just do it. It's just very straightforward. We know where the trend is going. And the Fed should be a little bit patient here and listen to Barry Sternlicht and Elon Musk, economist extraordinaire, and Jeffrey Gundlach, who's one of the greatest bond traders of all time, saying the exact same things. The Fed needs to be careful. This stuff works on a lagged basis. So you just see it across the board. And then on the producer side, it's even more extreme. I mean, going negative. It's just, and they want to, go bananas on the hikes. Just talk up the quantitative tightening and say, we're pulling $2 trillion of liquidity. We're going to go, we're at restrictive on the hikes. If we need to do more, we'll do more. But right now we're focused on quantitative tightening. We all know it's sterilized, so it has no effect. And let's just see what happens over the next couple of months before they just tighten the doors off, which they're probably going to wind up doing. But then they'll just reverse more quickly, which is a good thing. This is the clip from Jim Paulson. You definitely want to listen to the details, what I've been saying, that the market always bottoms before inflation peaks. For the last 100 years, inflation peaked in June. The market bottomed in June. I think we're in good shape as it relates to Cooper Standard. The credit markets are still closed. That's not good news. But we'll see if that improves somewhat after the next week's Fed meeting and presser. Look, there's a year and a half to get it done. So maybe it's next year, but I think they're going to get something done on the $300 million before the end of the year. I think as the equity markets rally into year end, they'll be able to pop it out, not at the best terms, and then they'll refinance it a year or 2 years out, and we're off to the races on that front. But I think the business itself is doing unbelievable, and I think we're going to start to see a few quarters of $30 million of EBITDA, and people's minds are going to be absolutely blown. This was, I screenshotted this from yesterday morning. Christina Partsenevelis was talking about NXPI and this note, industry note from Bernstein, Stacy Rasgon. Auto chip shipments now shipping greater than 50% above historical trends, and overall channel inventories are reaching record highs. This is huge for the OEMs, the new producers, and it's huge for the auto suppliers that supply to the OEMs, like Ford, GM, the biggest two clients of Cooper Standard, which means they're producing the cars, which means they need the sealers and the fuel delivery systems and the cooling systems. So I think we're going to start to see major EBITDA quarters, and I think their estimate, into year end may in fact come true in terms of the EBITDA that they were looking for on the last call, which is going to make more people want to finance them. So things are. I'd rather the business is doing well and the credit markets were closed than they got a refinancing done and the business was doing poorly. Because if the business is doing well, eventually you get financed. If you're financed and the business is doing poorly, you won't be able to service it. So I think the good catalyst is happening. The other catalyst I think we're going to see in coming months or sooner. Sentiment, it got a little bit better this week on the retail side, 26% bullish. Fear and greed is back to fear. That's good for buyers, bad for sellers who are selling in the hole. And equity, National Association of Active Investment Managers, they're up to 33%. They're going to have to chase their tails off into year end as we get some positive catalysts. So that's good news. As for economic data, we kind of have gone through it ad infinitum as it relates to the inflation. Retail sales actually did come in better than expected this morning, so that was good to see. Manufacturing, New York State manufacturing came in better than expected. Jobless claims came in better than expected. So the economy's kind of humming along in the face of these headwinds, and then earnings continue to hold up, still near 244. Every analyst under the sun was calling for a 20% re-rating last quarter. We got a 2 to 2 and barely 2 somewhere between 2 and 3% re-rating, which is nothing, but not 3%. I think it's about 2.5%. And that's the story. So, you've got the headlines and you've got the facts. We try to lay out the facts every single week. We hope you find it helpful. Hopefully by next week, we'll have our website back so we can do a full podcast video cast. But in the meantime, I want to thank you for tuning in. We'll see you next week, same time, same place. Bye for now. And in the meantime, make it a great one. Take care.